The 2008 financial crisis explained how greed broke the world.
In September 2008, a 158-year-old Wall Street giant collapsed almost overnight.
$600 billion disappeared, shaking the global financial system.
Retirement accounts vanished. Life savings evaporated.
Millions of people lost their jobs in a matter of months.
By 2005, homes were no longer places to live. They were chips in a high-stakes game.
As prices rose, fear replaced logic. Everyone rushed in before it was too late. As prices rose, fear replaced logic. Everyone rushed in before it was too late.
Behind the profits, the loans were rotting from the inside.
Garbage was stamped AAA, and the world believed it.
A few saw the cracks, and they knew what was coming.
Mortgage offices became approval factories, handing out massive loans with barely a second thought.
People earning $40,000 a year were suddenly approved for $500,000 homes.
Adjustable rates and balloon payments replaced simple explanations, burying risk under complexity.
No income, no job, no assets. Somehow, no problem.
Even without savings or credit history, approval came easily. Subprime mortgages welcomed borrowers once considered too risky. Even without savings or credit history, approval came easily.
Rising prices convinced everyone the risk didn't matter. The housing market turned into a nationwide gold rush.
Everyone believed they were getting rich just by owning property.
Traditional lending rules were quietly abandoned, replaced by speed and profit.
Down payments vanished, removing the last barrier to borrowing.
If you had a pulse, you had a mortgage.
Banks printed loans as if money had no consequences.
Homes were no longer shelters. They were bets.
Speculation wasn't limited to Wall Street anymore.
Everyone believed housing prices would never fall.
Real estate replaced careers as the main obsession.
Everyone believed they were holding a winning ticket.
No one asked what would happen if prices stopped rising.
As more people rushed in, prices climbed even higher.
The higher prices went, the more desperate everyone became.
Rising prices created urgency. Urgency created reckless buying.
It was like throwing gasoline on a fire.
Many borrowers could barely afford the introductory payments.
Underneath the excitement, the loans were rotting.
Fear of missing out replaced fear of risk.
We have to get in now. Look at that surge.
Baby.
I know, but it feels risky.
Income was exaggerated. Documents were skipped.
Banks bundled thousands of risky loans together.
They were marketed as safe, reliable, and profitable.
Toxic mortgage bundles were stamped AAA, the highest safety grade possible.
Investors across the world trusted the labels and bought in.
The banks paid the agencies. Optimism was rewarded. Honesty was not.
Bad loans were dressed up as gold, and no one wanted to look closer.
Complexity became camouflage for danger.
The correlation metric stabilized the synthetic structure across the CDO trenches.
Wait, I don't follow the convexity adjustment.
Mortgage securities were sliced and reshuffled into CDOs.
Garbage was transformed into something that looked like treasure.
A few skeptics read the fine print and saw the cracks.
A few investors saw the cracks early, but no one wanted to listen.
Housing had never fallen nationwide. Betting against it sounded insane.
Once teaser rates expired, many borrowers never stood a chance. The math only worked if housing prices rose forever.
So they went to Wall Street and asked them to build one.
There was no simple way to bet against housing.
But charging fees for it? That sounded amazing.
Betting against housing? They thought it was ridiculous.
It felt like free profit. Nothing could fail on that scale. Or so they believed.
They called it insurance, a simple contract to protect against collapse.
It was like buying fire insurance on your neighbor's house and hoping it burned.
Every bad loan was now tied to countless side bets. Losses wouldn't stay local. They would spread everywhere.
Banks borrowed more to win bigger.
Oversight slept while risk grew. The louder the party, the deeper the cracks beneath.
Bonuses grew. Warnings faded.
By 2007, the first warning signs appeared. A few homeowners quietly missed their payments.
A handful of properties sat unsold. At first, no one cared.
There were always small losses, they said. This was nothing new.
But this time is different. The weakest loans began to fail.
The music was still playing, but the rhythm was slowing.
At first, the collapse whispered instead of screamed. Foreclosure notices multiplied. Empty condos spread across cities.
He's the tap now.
Analysts
called it a cooling market.
The assumption holding everything together shattered.
Then the unthinkable happened. Prices fell nationwide.
As prices fell, millions discovered they were trapped, owing more than their homes were worth.
When teaser rates expired, monthly payments exploded, and millions couldn't keep up.
Defaults didn't rise slowly. They detonated.
Safe assets had become financial poison.
When trust vanished, the system froze.
The shockwave began with hedge funds.
If Lehman could fall, anyone could.
Credit markets froze overnight. Without credit, businesses began to suffocate.
Liquidity vanished. Panic took its place.
The crisis moved from balance sheets into living rooms.
Millions lost their jobs almost overnight.
The crisis became human.
This was no longer an American crisis.
Let it burn or save the system. The system survived.
Trust never can recover.
The collapse was not an accident.
When risk is ignored, collapse becomes inevitable.
The world moved forward, but never forgot.
The next crisis never looks dangerous until it is.